Canada just finished a federal election where really nothing changed. With the election results back and a recent Bank of Canada update, what can we expect in the real estate and mortgage market? Early in September and midway through the election campaign, the Bank of Canada made its sixth interest rate decision and announcement of the year. Once again, like the election, nothing really changed. The bank rate remains unchanged since its rapid decline as an immediate response to COVID-19 back in March 2020. I know that I've been watching the announcements with some interest to see the bank's best forecast for recovery from the pandemic. And as the pandemic continues to hang around, and while Alberta and some other parts of the country are experiencing a fourth wave, we continue to see COVID-19 impacting our recovery. Since June, we have seen a pullback of recent high levels of housing activity. This was both expected and is even appreciated by many would-be buyers. In the Alberta market, we're seeing fewer cases of multiple offers and more ability to negotiate on price or other terms. We'll continue to see low rates for a while, both from the Bank of Canada as well as in the fixed rate market. I project we'll continue to see 5-year fixed rates near 2% interest into next year. And variable rates are even lower, hovering around 1.5%. And now may not be the time to make that selection, given the bank's desire to raise rates as the economy recovers. While we can expect rates with the Bank of Canada to remain stable well into 2022, I would be very surprised to see it last much more than a year or so from this fall. During the election campaign, there was a lot of talk about the housing markets. Portion of our great country are really unaffordable, so it's really a relevant discussion for many. A few things that we can expect to see over the next few years are a continuation of the great first-time homebuyers incentive program, which adds to the down payment, thus reducing mortgage payments. We've also seen some talk of a possible tax on capital gains for those who are flipping real estate quickly, but it won't really impact most homeowners who stay in their home a few years. There's also talk that the maximum purchase price for mortgages with less than 20% down payment may go from $1 million to $1.25 million, with that new cap being indexed to CPI inflation going forward. Now is still a good time to be in real estate, or to get into things while they've slowed down a little bit. With low rates and improved values, it might make some sense to use some home equity for investment, renovation, or debt consolidation. For those of you who are looking to purchase, especially for the first time, the next several months will provide a great balance of low rates and less demand, making your negotiation position stronger than it has been since the spring of 2020. As always, I hope to hear from you if you have any questions or if you're looking to understand how this affects you specifically. Until next time.